Hello everyone, welcome back to Day Trading Attack Penguin. In the last episode, we taught you how to identify the correct supply and demand zones. These conditions act like a filter for trading decisions, significantly improving the accuracy and reliability of your trades. In today's video, we will show you some actual chart examples to demonstrate how we analyze market trends and mark supply and demand zones. So if you find this helpful, be sure to like and support us. And don't forget to subscribe to our channel. In the 4-hour gold chart, the market has been in a long-term uptrend with several imbalance, creating volatility. These imbalances often occur at key structural levels, and after meeting certain conditions, accurate supply and demand zones can be drawn. It's important to note that supply and demand zones that have been tested by the market are usually no longer considered useful, as the market forces may have already been exhausted during the previous test. In some cases, we also observe how price reacts to key levels. For example, if price breaks a certain level without showing any clear respect, the effectiveness of that supply and demand zone can be deemed invalid. Many beginners perform poorly when trading supply and demand zones. One common example is when a bullish breakout signal, BOS, forms near the next supply and demand zone, but before the demand zone appears on the chart, the price hasn't yet created multiple support levels or internal structures. This may indicate that the market is accumulating liquidity and that the liquidity may not be enough to support a large reversal. Therefore, we would choose to ignore this signal. However, we need to wait for the market to create more support and internal structures to support a large reversal. The real trading opportunity lies in waiting for the price to build sufficient support and internal structures before reaching the demand zone, which will attract smart money into the market. Once the price bounces in the marked demand zone and a clear breakout structure, BOS bullish signal appears, we can confirm the entry. This analysis method, combining supply and demand zones with market structure, helps us identify high-probability trading opportunities and gain larger profits as price develops. When trading supply and demand zones, multi-time frame analysis is a very effective strategy. We usually start by observing the market's larger trend on the 4-hour chart, as it provides a clear market structure and key supply and demand zones. However, relying solely on the 4-hour chart is not enough. To capture earlier trading signals, we switch to smaller time frames, such as the 15-minute chart. This method allows us to gain earlier information and quickly identify market breakouts, BOS, or trend changes. By analyzing on smaller time frames, we can find clear bullish signals near key levels. These signals help us confirm the entry earlier, seize the opportunity, and increase potential profits. Basically, in this technique, we focus on 3 main concepts: imbalance, breakouts, and liquidity sweeps. You can use any trading setup combined with the supply and demand concept. Step 1. We need to identify significant imbalance movements in the market. These imbalances often manifest as rapid price movements within a certain area, leaving unfilled price regions. This movement shows an imbalance in the forces of buyers and sellers and forms the basis for marking supply and demand zones. Step 2. Focus on whether these imbalances occur at key structural levels. When price breaks a significant market structure, it is often accompanied by significant imbalances. This phenomenon indicates that the market is gaining momentum in one direction, and once the conditions are met, we can mark this area as a supply and demand zone for further analysis. Step 3. Observe whether the market has created more support and internal structures near key levels. If multiple confirmations of support or internal structures occur, it indicates that the market may be accumulating liquidity for a large reversal. This step is crucial as it helps us judge the effectiveness of the supply and demand zone and whether price could reverse at this area. The first 3 steps help us define potential key trading areas, while step 4 focuses on confirmation in the lower time frames. This step is crucial as it is the core of translating theory into actual trading decisions. In a strong trend market, price typically forms small pullbacks, which might not reach the marked supply and demand zones, potentially causing us to miss many trades. So, when we encounter suitable trading opportunities, we must capture all the profits and amplify them. How can we do this? If we place the stop loss just below the recent swing low, it is a safer approach, but might result in a risk-to-reward ratio of only 1.2. This does not meet our condition of entering only when the risk-to-reward ratio is greater than 2, because this ensures we can still profit even with a win rate lower than 50%. Furthermore, if we set the stop loss further down, for example below a distant low, the risk-to-reward ratio might drop to 1:1. Although this greatly reduces the chance of being stopped out, it also requires our win rate to exceed 50% to remain profitable in the market. So how do we balance the risk-to-reward ratio? The answer is, when price reaches the target area, switch to a lower time frame to confirm the entry at a better price. This not only reduces the stop-loss range, but also allows us to catch the trend with better risk-to-reward conditions. Let's look at a real trading example with XAU-USD. First, we identify the supply and demand zones formed by imbalance movements on the chart. These zones typically have a higher probability of reversal. Generally, I set up alerts for price gaps and supply and demand zones, so no matter where I am or what I'm doing, I will be notified immediately when price reaches the right entry position. Switching to the H1 chart, we see that the price seems to have broken through BOS breakout structure. Then, switching to the M15 chart for confirmation, we can observe a trend change. CHOCHEH meaning price has already undergone a trend shift on the smaller time frame. At this point, we can consider entering. Based on previous teachings, there are several entry points, including FDGs, fair value gaps, on smaller time frames, liquidity zones in internal structures, and BOS. Depending on your trading style, we typically wait for price to pull back to the smaller time frames FEG before entering. We place the stop loss at the low and set the target at the external structure on the H4 chart, ensuring a higher risk-to-reward ratio, ideally 2, before placing an order. But when first switching to the H1 chart, you'll find that the internal structure is relatively weak, so the price will create more internal structures to accumulate liquidity before potentially reaching the external structure target on H-hour. If we miss this opportunity, there's no need to feel regretful. As the internal structure on the H1 gradually accumulates, you'll see a second entry opportunity, usually at a liquidity zone formed by two identical low points on the H1 chart. Then adjust the setup based on the new external structure on the A4, adding a position reduction or moving the stop profit. Psychological challenges and discipline in trading. The nature of trading is counterintuitive. Even if we have a plan for exiting, we often lose confidence when faced with profits. For example, even though we could have maintained a 5 RR, risk-to-reward ratio of 5, we might exit early due to hesitation, missing out on larger profits. To address this, we use our proprietary trading tool, ES, strictly following these steps. 1 or break-even, when profits reach 1 RI, adjust the stop loss to break-even, ensuring the trade won't result in a loss and locking in minimum profits. 2R moving stop profit, when profits reach 2 RIU, dynamically adjust the stop profit position to lock in higher profit goals as the market moves. In our attack, Penguin Land Learning Community, we'll go into detail on how to use this EA tool to achieve more efficient and stable trades. So, that's all for today's video. I hope this video brings value to you. If you found it helpful, please click the like button to show your support. If you're new here, don't forget to subscribe to our channel. See you next time.